Hey guys, welcome back to our mortgage process educational videos for the buyers and sellers. I got John here, as you know, a great guy, massive in the mortgage industry. So John, I'm gonna get right to the question on, we talked about the pre-approval and pre-qualification. When they do the application, they come in, you're gonna start looking at, which one they want to get qualified. Ideally, pre-approval is more, has more weight to it, and that's what we want to do. But now the application comes in. You got the application. What are you looking at in the application to qualify them? And what does a buyer need to know even before putting the application in? Let's talk about that a little bit.
That's excellent. Okay, so let me break it down by category. Credit. That's the first thing that we look at because everything revolves around credit, right? So we look at the credit report and we want to identify what are the three credit scores, right? 9 out of 10 people have 3 credit scores, and we have to use, by law, the middle of the 3. So Rummy, if I pull your credit with a soft credit check that doesn't have any impact to you whatsoever, and you have a 700 credit score with Experian, 720 with TransUnion, and 740 with Equifax, the middle credit score is 720, right? Because your low score is 700, your high score is 740. So 720 is your middle credit score. Okay, great. We also make sure that the name that you gave us and your date of birth and your social security number matches what the credit bureaus have on file. The other day, a team member pulled a credit report and the lady's last name was different than what was reporting to the credit bureaus. She just got married 2 weeks ago and didn't tell us that, there's a discrepancy with the credit bureau. So it didn't generate a credit score because of fraud alert, but it says according to the data you inputted, her last name is different. So we had to get our marriage certificate and then get her credit scores. So we look for any anomalies, any errors, because that is critical and important to take care of it now rather than later. Then we look at the body of the credit report, page by page, to make sure that there's no derogatories, collections, charge-offs, bankruptcies, foreclosures, right? I've pulled credit where the buyer had a 780 credit score. And if you just focus on credit score, you're like, oh, great, pre-approval in 2 hours. No. At the bottom of the credit report, she sold a house where the mortgage was paid late the last 3 months.
Ooh.
So now she has 3 back-to-back late payments on a mortgage that was paid off through a sale within the last 12 months. And guess what? She doesn't qualify.
Wow.
So high credit scores doesn't guarantee a pre-approval. We got to look at every account. We also look at child support. Not a lot of people know that child support gets reported to the credit bureaus, right? And it'll say that they owe 10, 15, 20,000 in arrears. So we look at all these things. If there's a bankruptcy, don't worry, it's fine. We just got to see when the discharge date was.
Right.
Right? Because Fannie Mae, Freddie Mac, FHA, VA all have different guidelines on the seasoning after a bankruptcy. Chapter 7, Chapter 13, it's all different. We look for foreclosures, short sales. So the credit report is a very important document that has to be studied with the person on the phone.
Okay, so we're looking at the credit score right now, and then we are looking at, I'm going to be a little bit devil advocate over here. Are you looking at student loans?
Yes.
Okay, so the credit report shows that and how much you owe. I thought it wasn't really.
It doesn't really go by what. So if there's a payment reporting, right? If you have a student loan for $65,000
Right.
and the monthly payment is being reported, we go off the monthly payment. But
Okay.
how many student loans are deferred, right? Because they haven't graduated, or they keep deferring it, or they're in what is called forbearance. So if there is no monthly payment, here are the rules. With FHA mortgage program, we take the balance of all the student loans and multiply it by 0.5% to come up with the monthly payment. Fannie Mae has a 1% rule. So you take, which is conventional. If you take all the balances and you multiply by 1%, that is the monthly payment. Freddie Mac is 0.5%, as is VA. Yeah. So we look at the student loans to see if they're deferred or not deferred. Car leases, you could lease or you could finance a car. If you have a lease, and let's say you got 2 months left, the theory is that you're going to return it to get a similar lease. So we cannot even exclude it from your DTI. But if you have a car with 6 payments left, and the payment is $900 a month because it's an SUV, and guess what? Because you have less than 10 payments, I could exclude that monthly payment from your DTI. So that $900 payment on your SUV, because you got 6 payments left to pay it off, and it's a car loan, I can exclude it from your liability, so it has no impact to your pre-approval.
Got it. So we're looking at that. Thank you. That was my next question. What about you got this. What about some payments on health, right? When you go to the hospital, you couldn't pay for it, and then now they are coming after you. I'm
Yeah,
not sure even if it's on the credit report or not. I don't know if it's what they're supposed to be, but let's talk about that a little bit.
yeah. So a lot of people don't know that if you don't pay your hospital bill, your doctor bill, even your dentist bill, because you think, oh, I got insurance, they're going to cover it. Sometimes the provider doesn't communicate well with the insurance carrier.
Yeah. Yeah.
There's some kind of discrepancy there. So what happens? You keep getting notices in the mail to pay your bill. And if you ignore it because you got insurance, they're going to take care of it. No, they're not. Something happened. That's why they're sending you the notice. That eventually ends up on your credit report. So medical collections, depending on the mortgage program, are okay. You don't have to pay them off. But in excess of $3,000, you're going to have to pay them off depending on the program type. So anything that becomes a collection on your credit report, more than likely, depending on the program, depending on the findings, you're going to have to pay it off. Anything that's a charge off. There was a lady with a Honda and $18,000 charge off. If the debt was charged off, no other action is required.
Got it.
Right?
Okay. Okay. So we talked about a lot of this, the good credit, the bad credit. Obviously, we want to look at, what do you owe, what do you don't owe? What do you recommend for a client to do? Can they pull their own soft credit from Expedia or, these just to kind of look at it and then start analyzing this, or should they come to you first?
Come to me first, right? Coming to me, it's like, like for example, if you have like an older vehicle and you're hearing a noise, you hear some kind of metal grinding in the car, you call your mechanic, you start saying, oh God, I saw some smoke and some oil on the floor. They're going to be like, hold on, come to my shop. Let me look under the hood. And then I can educate you on what's going on and have an intelligent conversation with you.
Yeah.
That's the same thing with me. You might be like, oh my God, I didn't pay this doctor bill, but it could be there, but it could not be there. My sister bought a house, I co-signed, but I don't know if the mortgage is on my, it's okay. Call me. Let's take a look under the hood. Let's analyze your credit report. And maybe there's a way that those items are not going to affect you. Like, for example, a buyer called me already disqualified. He's like, I already know I'm not going to qualify. My brother bought a house. The mortgage is $6,000 a month. It's on my credit report. I know it is. I know I'm not going to qualify. I'm like, hold on a second. Let's take a look. I pulled his credit. Yeah, $6,000 mortgage payment on his credit report. But guess what? His brother pays for it for the last 2 years out of the brother's bank account. So I said, if your brother sends me proof that he's the one responsible, I could exclude it, and now you qualify for the house you want. He's like, I never knew that. I said, exactly. So that's the beauty of like speaking to me first, and just don't do anything. Don't transfer money. Don't pay off for credit. Let's look at your credit report. Let me read it with you. Good. And then give you the proper advice.
Yeah, because you're coming to an expert to understand over, I don't know how many years, 20 plus years in the business, decades in the business, to looked at every scenario and how to fix it and how to make it better. And so that way you could qualify, because, being, speaking to a client today, she said, well, I co-signed and he's not paying this. Listen, it's okay if you did it. Don't do it moving forward. That's what I'm recommending for everyone that's out there. Please, 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 please look at it thoroughly, speak to the lender, get a guarantee. I don't know, right? If you're going to go co-sign for someone, making sure that you have a significant other or significant sibling that you're doing it for a good reason. Not, I hear horror stories, or I did it for a friend, I did it for third cousins, and they're not paying, and they're screwing up. Like, credit score are so important. In the lump sum of credit report, what is one advice that you want to give before we get out of here for the credit report?
Listen, it's not just a mortgage or buying a house or anything like that. Credit is just an important part of your life in general, right? If you got kids and they're going to need student loans and you're going to co-sign, credit helps you. Your car's old and smoke coming out of your tailpipe and your hood, you need a new car, It's all about the tier one credit, right? I just went to a dealership to get my mother-in-law a car, and they were all about tier one credit, and she got a cheaper payment than the previous people that were with the guy that I spoke to. So credit is everything, everything, especially in this country. So some of the tips I can give you real quick before we log off is obviously pay everything on time, right? You want to make sure you pay
Right.
everything on
Right.
time. Number two, never ever max out your credit cards, right? If you got a Discover card and your limit is 10,000, don't keep a balance of 9,900, right? Because you're not showing that you have financial health or financial ability or financial responsibility, I should say, to keep that card in good shape. You always want to maintain high credit limits, low credit balance, and the age of your accounts matters. If you got a
Yeah.
Capital One credit card for 3 months versus a Discover credit card for 3 years, that Discover, because it's 3 years old, is much stronger and more valuable to your credit report than a Capital One that you just got 3 months ago. So never close a credit card account, pay it off, keep it zero if you don't like it, but the age of the credit card matters. High credit limit, low credit balance.
And I want to leave off of this, and I'm going to be vulnerable in this video too as well. At one point in my life where, I was starting my business and everything, and I was maxing out my, things happen in business, things happen in life.
Yeah, life happens.
And then somebody called me up, hey, I could consolidate all of your credit reports and everything, but I had this credit for like 10 years. And what they did was close that credit report down. And I didn't know that. I didn't read the fine line. And they said, okay, we'll work with Chase to close it and all this other stuff. I'm like, wait, no, that actually hurt me because that was there for 10 years already, and I had to rebuild other credit cards. And I had other ones, right? But the reason being I'm saying this is that even though when you get these consolidations and all this other stuff that's out there, making sure that you don't close your credit card up, because that is definitely building out your history. And even for your kids too as well, start them at, I think it was 13 or no, 13 the bank account, and I think 18 is when they start you could have them as a copay, because I'm doing that for my kids too as well. And it'll help them because if they're a co-signer, they're building their, after 13, I think it was, and you could prove me wrong, I think it was 15 or something like that, and they could be a co-signer, but obviously they won't have access to it. It will start helping them build a history. History is so important.
Correct.
Like credit score is important, and like what you said, the balance is really, really important too as well. Thank you. Watch out for the next video, guys. We're going to talk about down payment, how you could actually take advantage of what the programs are out there too as well. And because this video is going to be timeless, we are going to focus just on what do you need to do on focusing on down payment. Have an amazing day. Thank you for chiming in. Be great.
Got it. Later, guys.